Good morning and welcome to this Tuesday, November 14th edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host here for the next 20, 30 minutes or so as we prepare for another market open. Good news for the bulls. We are absolutely flying in pre-market. The CPI data came out this morning. So this was for the month of October, and it came in better than expected. The headline number was flat. Expectations were for a rise of 0.1%. And if we strip out food and energy, the core inflation number for the month came in at 0.2% rise. Expectation was for 0.3%. As the market continues to realize that inflation is no longer a problem, or certainly not the problem that it once was. We're seeing the stock market take off. We're seeing bond market take off as well, with yields dropping back down below that key 4.50% level. This could be the neckline breakdown on the 10-year Treasury yield. And as I've been talking about, that, in my opinion, would send prices much higher, stock prices much higher, and that's what we're seeing in pre-market action. So we're going to get into all of that in just a couple minutes. First, I do want to welcome you to the show. Those of you who are new, we've been doing this for quite a while now. We started this business here at Earnings Beats back in 2004, so we've been doing it now for almost 20 years. I've been doing these shows and webinars and live events for many, many years as well. If you want to learn more about me or Earnings Beats, you can also go over to stockcharts.com, where I write. If you go into the website, just click on articles. I can actually show you in a few minutes, but click on articles, and then there will be a drop-down menu, and just make sure you click on Trading Places Live with Tom Bowley, and you can follow me there. I tend to post once a week, maybe occasionally a little bit more often, but for the most part, once a week, and usually on the weekends. But that's one way to follow. We have a free newsletter, which I'll talk about in a little bit. But there are ways you can follow me. But I really appreciate you tuning in here, spreading the word about Earnings Beats. Been calling for a melt up in the market here in the fourth quarter, so I'm not at all surprised by the Tame inflation data and the very, very bullish reaction this morning to that data. Let's go ahead and get things started. I am going to jump in here to the recap from Monday's action. Dow Jones Industrial Average finished up 54 points. S&P 500 down just a little less than 4 points. Nasdaq down 46. Mid caps down 3. Small caps basically flat. Looking at it on a relative basis, we saw a little bit of leadership from the Dow, maybe a little bit from the Russell 2000, the small cap index as well. The laggard yesterday was the Nasdaq 100, which fell about 0.3%. But overall, not a bad day, especially considering how strong we've been since the close on October 27th. That was when we talked about historically the market moving from a very, very bearish period to a very, very bullish period. And you've seen the results. I mean, I'm not making this stuff up. I do a lot of research. And the 27th tends to be that period where the market you flip you go from the cold water, the ice cold water, to the hot water at the spigot, just overnight. Don't ask me why. I just think the market prepares for a very, very strong end of the fourth quarter, which is typical. And I think we're seeing it this year. Transports yesterday down about 1/3%, still struggling. Be very interesting to see what transports do with this lower inflation data today. I suspect we're going to have a pretty decent day across the board. Just to give you a little bit of an indicator, well, let me go through the sectors and industry groups, and I'll show you pre-market what we're looking at. Energy yesterday was the leader, up about 0.75%. Healthcare up about 0.6%. Discretionary rising about 0.4%. So a little bit of a mixture. We had a neutral sector, a defensive sector, and an offensive sector leading the market yesterday. Autos, big day. Tesla starting to roll. I think Tesla looks very, very interesting on a chart. I'm going to talk about that one in just a little bit. Medical equipment also up pretty nicely yesterday, rising 2%. Aerospace jumping 1.3%. We have seen a big rise, big recovery recently in Boeing. That is certainly helping the aerospace group as it's climbed back up well above its moving averages. You can now see a golden cross on the aerospace chart. That's when you get the 20-day moving average to cross the 50-day moving average. It's really the golden cross is when short-term moving averages cross over longer-term moving averages. It's just a sign that momentum is really beginning to turn more bullish. Of course, it can be whipsaw in a trendless market, but I think right now we're seeing a trending market, and it's trending to the upside. All right, so let me show you those futures. You can go into stock charts and click on symbol summary, and then you can type in whatever symbol you want and get your updated futures. But let's start with the diamonds. The diamonds are up more than 1% today. Then we'll move on to the spider, up 1.33% today. QQQ up 1.68% today. And then finally the IWM, which is now up 3.31% for the day. So something like that triple IWM, which is the TNA, up more than 10%. I saw just probably 5-10 minutes ago was up 12%. So very, very strong start to the day for equities across the board. I'll talk about Tesla later, but you can see Tesla up almost 5% today, up $11 to 234. Really nice day there. NVIDIA just keeps on moving, up another $11. I got out of this one way too early, not complaining. May have had a really good trade, but this thing just will not stop. Looks like it's going right up to the previous highs. NVIDIA has its earnings coming up, I think, on November 21st. So that would be next Tuesday. Stock is right up at an all-time high, ready for probably another blowout earnings report from NVIDIA. All right, moving on to the 10-year Treasury yield. So let's get an update here. 10-year Treasury yield right now, 4.477. So basically 4.48%. Been talking about watching for this head and shoulder breakdown. I said yesterday that test of the 20-day could have been the right shoulder. I thought a more symmetrical shoulder would have taken us back up to about 480 to match that 480 left shoulder. But that 470 might have been it. With this lower inflation reading this morning, this is very, very good news for the Fed. It's very, very good news for anyone following the stock market because when we get a breakdown in rates, that with everything else being equal, lower rates mean future earnings are much more valuable. Strip everything else out. Forget about what any individual company is doing. When rates fall, future earnings, the value of future earnings rise because you're discounting those future earnings back using lower interest rates. And if you know anything about present value, if you're discounting back with a lower interest rate than what you were doing previously, it's going to send the valuations higher. So we saw what happened to valuations. Do you remember back in 2020 in the pandemic when rates went to basically zero? That's when the stock market absolutely exploded to the upside because many of these technology names really didn't see a slowdown in their business. Many of them saw actually business accelerate. So the higher growth rates were contributing to higher market valuations, but the absolute key was the declining yields that we saw, the rapidly declining yields. That was sending valuations through the roof, which is why we saw the Nasdaq jump as much as it did relative to the S&P 500. Many of the S&P 500 names, or more of those names, did not do well. You had areas like recreational services, which includes the cruise lines. You had areas like airlines. Those areas were crushed during COVID. So those aren't in the Nasdaq 100. They're in the S&P 500. So that's why we saw that huge outperformance. But a lot of it really just boiled down to lower interest rates. And now with rates tumbling, potentially breaking down below this neckline, which I've talked about in recent weeks, the measurement goes down to 4.10. So 4.10 would be what I would expect initially. Doesn't mean that's going to be the low. I actually think probably we're going to see rates between 3 and 5%, probably for an extended period of time. But I think now we're working our way back down. And if this does turn out to be the breakdown of this head and shoulder top, I believe we have seen the high in interest rates. I don't think we go back up through 5%. That's my call. Yeah, so anyway, really big inflation report this morning. Again, for those just joining in, the October CPI came in below expectations. The headline number was flat, and the stripped down version, taking out food and energy, the core CPI came in with a rise of 0.2%, while the overall market was expecting a 0.3% rise. S&P 500. So going into today, we're already starting to trend higher. I mean, I think it's pretty clear. We've got an uptrend in play. We went through the 20, we went through the 50. We're holding on to those moving averages. I said at the end of last week, we cleared 4,400. That to me was the absolute price confirmation that the correction had ended. We're going higher. I think now use that rising 20-day moving average as key support on the daily chart. Until we see otherwise, that's the way I would be approaching the market. Nasdaq 100 also easily clearing that October high. And if you're not seeing it, let me just walk you through this correction, because a correction is usually nothing more than a series of lower lows and lower highs. So here was a lower low, a lower high from that high, lower low from that low, lower high from this high, and then another lower low. And now what happened? There is no lower high. In fact, we have a higher high that reverses that downtrend. So I believe we've gotten technical confirmation of a lot of the historical patterns that we've talked about. And even some, I mean, we had some positive divergences showing up on 60-minute charts, not so much on the daily charts, which made it a little bit more difficult to call the exact bottom. Although the historical pattern certainly called the exact bottom. But again, I don't use seasonality and historical patterns as my primary reason to trade. I use it as certainly a confidence builder. If I like a stock or I like an index, I think the market's going higher, and we just so happen to be moving into a very bullish period. Yeah, that can be a game changer. And so we've seen a little bit of that here over the past 2 or 3 weeks. Moving on, IWM, which has been the weakest. Even with, let's go back and look at the NDX one more time here. See how the NDX just keeps moving higher and keeps putting in higher highs each day? Look at the IWM. We had a couple of gap ups, but really, we didn't see any major, follow through. We actually have been coming down for the last week. Did have a couple hollow candles the last 2 days, which were nice. Today, we're going to get another big gap up. I really would like to see the IWM continuing to be bought during the day. I feel like we're getting the gap ups. A lot of individuals are chasing the gaps, but then the professionals are running away from the IWM and moving more into areas like semiconductors, software, which is leading the Nasdaq 100 higher. So that's been part of the problem with the small caps. We're getting the big gap ups. We're not seeing a lot of follow through. Today, it looks like the IWM is going to be the best of all of them from a gap up standpoint. But what happens after the opening bell? Do we see more intraday selling on the IWM? Just watch 2 key ETFs here in addition to the IWM. KRE, which is the regional bank ETF, and you can see gap ups and then failure. Did have a little bit of a hammer yesterday print. That's nice. And then the other one is the XBI. XBI is small cap, mostly small cap biotechs. There are some large cap in this particular ETF, but it's a very, very diversified ETF with many, many holdings. So a lot of the smaller and mid-size biotechs are in this ETF. And that's one of the reasons why it's been struggling. We did get a nice recovery, though, a nice hammer yesterday on this group. And I would expect that these 2 groups will lead today. So thinking that, let's take a look pre-market. What are they doing? KRE up 4%, up $1.61 all the way to 43.05. A move through 44 on a closing basis, and getting up through the 200-day moving average would even be better. So the KRE is one ETF I would be watching. The other is the XBI. XBI up almost 4% today, 69.90, almost here to 70. What we need to see is follow through during the day. Let's clear 72. That takes out the recent high. That takes out the 50-day moving average. And I'd really like to see it on an intraday basis. I'd like to see buying throughout the day clear key levels rather than having gap ups and failures like we've seen for the past couple of weeks. So watch those two, KRE, XBI. I think that's going to have a big impact on the IWM. If you're not aware, banks are number one. They're the largest holding of the IWM. And of course, they're going to be small to mid-sized banks. And then biotech is your second largest area of holdings within the IWM. And so the XBI is a pretty good area to, or pretty good ETF to watch as a barometer for the biotech area. So anyway, that's what we've got going on in pre-market. It looks really good. We'll see how we wrap up the day, but everything in the market to me looks bullish. I've been saying that for the past couple of weeks now. I said we're going to go back to 4,600. I really believe that. And I've also said, don't be shocked if we're testing all-time highs at some point this quarter, possibly even breaking out above it. 48.20, something like that on the Nasdaq, or excuse me, on the S&P 500 would be the level. Keep in mind, when we go up on the spider, I mean, right now, spider is up about 1 1/3. Well, if we're sitting at 44.15 or over 4,400, what's 1 1/3? 1 1/3 is going to be somewhere about close to 60 points, 60 S&P 500 points. So when we pull up the S&P 500, if we're up 60, we're going to be up at 44.71 roughly at the open based on what futures are saying right now. 44.71, getting pretty darn close to the 40, the last two highs, the last two attempted moves to the upside, just above 4,500, then up about 45.30. They're starting to come into play. And then here was your July high back at 4,600. And if we go back to a 5-year weekly chart, you can see the 4,800 all the way back at the beginning of 2022. That intraday high, I said 48.20. I was off a little. 48.1862. That is the number. And at the open today, we are only going to be about 350 S&P 500 points away. That's not a lot. I mean, we're not that far. From mid-November to the end of December, rising 7 or 8% has happened several times before. Don't be shocked. Anyway, we'll see how this plays out into year end, but I am very bullish and I maintain my stance. I said at the beginning of the year, I don't remember if I used 4,600 or 4,700 as my ultimate close for this year. I think it was 4,600, which again was that July high. Maybe what we're going to do, maybe we'll have this move up. Maybe this is going to turn out to be a cup. Maybe we have a little bit of a handle. And then toward the end of the year, beginning of next year, maybe that's our breakout. I don't know. I don't know how it's all going to play out. I can just tell you I am bullish. All right. Transports, talked a little bit about that. Got through the 20. Sideways consolidating. Really need to make this break back up above the 50-day moving average. Break this downtrend line. That, I think, would really get the transportation party started. Maybe it's already started, but it's still got quite a bit of overhead work to do. All right, we are now going to move into the chart of the day. For those of you who are unfamiliar with the chart of the day, if you go over to earningsbeats.com, you can scroll down. It's a free newsletter that we offer, the Earnings Beats Digest, where we have essentially a chart of the day 3 times a week, Mondays, Wednesdays, Fridays. This is totally free. Do it as part of our education process for the overall community, investing community, not just our subscribers at Earnings Beats that pay us. But this is a free newsletter. We've got literally tens of thousands that follow us. You should be on this. If you're not, it will help you in your, maybe your passion for investing and trading, hopefully help you in your journey. maybe learn some things along the way. I didn't get to where I was calling the market by chance. There was a lot of research, I had a lot of influence from John Murphy. He was probably the one that I learned the most from in the stock market. His books are fantastic. I would highly recommend them. The Visual Investor is great. The technical analysis of the financial markets, that was really like my investing Bible, if you will. I learned so much, and it inspired me to do so much more research. So check out those books. And by the way, I don't get anything for saying that. I just really like John Murphy's work. But anyway, if you'd like to be part of this EB Digest newsletter, name and email address, all it takes. Hit that subscribe button. We'll get you started. No credit card required, and you can unsubscribe at any time. There's going to be no hassle unsubscribing. You unsubscribe, hit the button, you're done. And that's fine. We want folks that, feel like we're giving them some value in this newsletter. And hopefully you'll learn enough and say, hey, you know what? I want to give these guys at Earnings Beats a shot, guys and gals. But right here, you can see this is part of the research that I've done. I don't think anyone, and I'll even put myself up against the Trader's Almanac as far as the amount of research that we have done and put into this. But for those of you who are non-members of Earnings Beats, you can go through this, download your free report, and everything, will be provided for you. It's a free report to learn more about the history of the market. There are some things that you absolutely must know. I mean, these are kind of Wall Street secrets. You never hear anyone go on to CNBC and talk about the timing and the way the calendar works. Very, very rarely do you hear much about this. And yet, I think it is one of the most important pieces of information to have in terms of understanding the market. So again, if you're a non-member of Earnings Beats, you go here. Now, if you're a member, what I'm going to tell you, I'm going to show you. I will log in here. And if you go to down here under annual member exclusives, and you can go all the way down, here are part 1 and part 2 of the series. Now, this is for folks that are willing to commit. So these are for our annual members only. If you become an annual member, this is free. This is just another perk. And you can see all of these different spreadsheets that we've provided to our annual members over the years. We take care of our members, again, especially. And by the way, our annual membership is half the cost of our monthly membership. If you sign up, it's a no-brainer. So the overwhelming, probably 90% of our members are annual members. So hopefully that'll give you some indication. You want to be an annual member. But here's the series where you can get it. So I know we've been receiving some questions from members, annual members, about where they can get their copy. Here it is. It's under annual exclusives. And right there, just click on part 1 and part 2, and you'll be set up. Let me see. I'll click on part 1 here. There it is. And long-term trends since 1950. You go down this thing, and you've got like 7 pages here on this free report. I don't know how many pages part 2 is, but it is a ton. And in fact, while I'm at it, I will just pull up part 2. You can see this is much longer, taking a much longer period to load. This goes over the secular bull market, the last decade. And I want you to look at all these charts and all this information that we provide in Series 2. And I got to give a shout out to my daughter, Erin Weber, who put this together. It is a fantastic visual summary of not only how the S&P 500 has done over the last 10 years, but also some of your favorite stocks. Think Apple, Microsoft, Tesla, Nvidia, Google, Amazon, Meta, AMD, Amgen, Starbucks. I mean, the list goes on and on. 16 of the top traded stocks along with the S&P 500. How do they trade? When's the best time to think about getting in from a seasonal time frame? All of this stuff is included in this amazing, look at the length of this again, 70-page PDF. You don't want to trade without it. Anyway, so annual members can go in here. Again, if you are let me log out. If you're just, somebody who just follows the show, you're not a paid member or an annual member of Earnings Beats, just come in here and click it. You can download that first report of the S&P 500. That is completely free. And then we have a special for part 2 that you'll see. But anyway, check that out. You really should have this information. For those of you who would like to just start out and try our service, right there, start your no-cost trial, 30 days for free. You will soon find out what many others already know. We are a great deal. Anyway, let's take a look at Tesla as the chart of the day today. So Tesla I pulled up because when you're downtrending and you see a gap, sometimes you'll have an island gap reversal, which is just one move down and then another move, you gap back up. Look at this one right here. This is an island gap, or just an island reversal. So you got this move down, a gap down, and then here's your reversal, leaving this candlestick on an island. Trying to see if there are not really others, because not all bottoms form like that, but that's the way some do. In this case, this was a gap down, and we've been trading in this sideways range. This is what's called an island cluster. And so all of these candlesticks are on an island, but we need a gap up to clear this probably 228, 230 level. And that's when today's gap comes into play. We'll see where it is right now. It's up $12, 236. Go back to this chart. So it's looking to open up here, which leaves all of these candles, this island cluster. All these candles are on an island, and we gap up, we leave them on the island, and this is when we tend to see a big market rise. So I really like what Tesla is doing today. I've been telling members it's one of my favorite stocks. I love the stock. If I had one stock to hold for 10 years, couldn't sell it, Tesla would be my pick, even more than Apple and Microsoft. I really believe 10 years, the stock's going to be much, much higher. Just my opinion. I'm not a registered investment advisor. I'm not giving advice, recommendations. I'm not licensed to do that. Just giving you some education, things that I look at in terms of these reversals. And just fundamentally, this company is very sound. We'll see where it goes, but I do like Tesla a lot. All right, I am going to finish this off looking at inflation, because remember, today it was the monthly inflation data for the month of October. And so what I have done, you can see this chart goes until September 1st. And that's because until this morning, the only data we had was through September of 2023. Now, later today or tomorrow, whenever Stock Charts updates it, we will have October 1st showing up, because we just had the October core CPI report come out this morning. So it always shows October 1st, even though it's November 14th that it's coming out. It always shows up as the October 1st reading, because it is for the month of October. Anyway, this is the actual core CPI over at Stock Charts, and you can get that by typing in $$ CCPI, $$ core CPI. So if you just wanted CPI, you'd take that out. If you wanted PPI, you'd put that in. If you wanted core PPI, you'd do that. But you got to remember the $$ at the beginning. And then we have right now the CCPI, core CPI. So there are your monthly readings going back. And I pull it up on a monthly chart, because the readings only come out once a month. You don't need a daily chart. It's going to be weird, because you're going to see just one line going across, I guess, the whole month. I don't know. It's going to really look strange. But anyway, do the monthly chart. Go back as far as you want. And then down below what I have is a 12-month rate of change. So here's your core, annual core, CPI. I mean, folks are still saying, oh, inflation's a problem. Well, I mean, I see nothing but the annual rate going down just about every month now for over a year. And this morning, what did we do? We came in lower than expected. So we go down again. Down here at the bottom, this is the monthly core. This is a 1 month rate of change. And so the 0.2 that we got today is going to show up on this chart. Now, what I want you to notice is, first of all, if you begin to start averaging 0.2% every month, what's your annual rate? What's 12 times 0.2? 2.4. That's right near the Fed's target rate, right? Well, since May, we have had the June number below 0.2, July below 0.2. Then we jumped up in August, went to 0.3, slightly above 0.3 in September, and then back down. I don't know what the actual reading is, because you can see they always round it in tenths when they get the report. But last month wasn't 0.3. It was 0.32. So 0.32, all these numbers, they give you the actual number at Stock Charts. So I don't know what the number is. Is 0.2, is it 0.17? Is it 0.23? I don't know, but it's going to be somewhat lower than the last two readings. And I mean, just look at the trend. We're trending down. We haven't had any of these big spikes. We haven't had anything over 0.5 now for the last year. And today's 0.2. Rates, or the inflation rate, continues moving toward the Fed's target rate. That's going to take a lot of pressure off the Fed to raise rates, which is why I think they're done. I think they're finally done. I guess we could get some other data that comes out that maybe trumps this, but I think the core CPI data is something that the Fed watches closely. And again, another big surprise to the downside. I think that's why we're seeing the market jump like it is today. So let's take a quick look at the market and see what is going on. Then we'll wrap up. We've got the Dow up 1.1%. That's 381 points, back up to 34.7. S&P 500 now up 64. I was looking at 60. Thought maybe we were going to be around 60. We're up 64, 44.75. The Nasdaq up 248. I'll tell you, the Nasdaq and Nasdaq 100 not far from all-time highs. Here's the Nasdaq, what it's doing, Nasdaq 100. But if we pull up that NDX, the NDX, the high was in July, the high was 15,932. We are at right now at 15,739, so getting close. And then if we pull up the 5-year weekly, you can see that the high was at 16,764, and we're at 15,736. We've got 1,000 points to go. That's only 7% to get back to our all-time high. So after the Nasdaq 100, which I think dropped about 40%, and maybe it's 38%. I know the S&P was about 28%. The NDX was down like 40% or closer to 40%. It's made its way all the way back up, went through our little correction, and now we're absolutely flying back to the upside again. So do we take out the all-time high by the end of the year, or maybe into the early part of next year? I say yes to the early part of next year. Rest of this quarter, I think it's going to be a little dicier. If any of the indexes take out the all-time high, it's probably going to be this one, just because it's been outperforming the other groups. If we pull up the S&P 500, look at that weekly chart. Still got a little bit more work to do to get through the July high, and then again to get back to that January 2022 all-time high. Anyway, things are looking up. Market continues to trend higher. I continue to believe, I have strong conviction in the market going higher. Those calling for crashes and collapses, I don't know what we'll talk about next time, but I think for now, market certainly seems to be painting a much, much more bullish picture. Check out our earningsbeats.com website. Get those historical trends, those PDFs. Very, very important to understanding how the market works. And and they go in. I mean, they do influence some of my long-term calls because, for instance, let me give you one more little tidbit of information. I've shared this plenty of times before, but we've had 14 bear markets since 1950. 14. 7 of them have ended in the month of October. So when we went down just recently, I know this wasn't a bear market, it was a correction, but when did it end? During the month of October. Anyway, that's it for me. Have a great day, everybody. Happy trading.